Hello and a warm welcome to this webinar brought to you by Royal London. My name's Vincent O'Connor and I'm a Senior Business Development Manager here for Protection at Royal London. And in this webinar today, we're going to take a look at the idea of whether we should be thinking about designing protection portfolios for our clients. Now, many of you listening to this webinar today may well have been in the industry for quite some time, and if you reflect back to the beginning of your careers, you may well not have had access to things like the internet because it didn't exist, or mobile phones, or even things like social media that we all take for granted today. This webinar today takes a look at whether we should be utilising technology to actually deliver better outcomes for our clients, and I'll show you what I mean by protection portfolios as we go through this webinar today. In terms of the agenda for this webinar, we're going to look at 5 main areas. We're going to start by taking a look at the state of the protection nation. We'll take a look at what the industry is doing and ask the question whether clients do still need proper advice by a human. Then we're going to look at profiling attitude to protection risks. Certainly, if you're an investment, a wealth advisor, somebody who talks to clients about retirement planning, you'll have those conversations already in the investment space. As an idea, should we be having similar conversations when it comes to protection? We'll take a look at protection objectives and what is it that people need when we boil it all down, and then we'll look at reasons for recommendations, some reasons why you can tailor the solution directly to your client's needs and wants. And finally, I'll give you an example of how we can design a protection portfolio. And we do have a set of learning objectives, and each of these learning objectives do relate to the agenda. So to start with, we're going to have an awareness of the current state of the protection market and the opportunities that come with having proper financial advice. We're going to be able to profile protection risks, actually profile protection risks and risk probability to your clients immediately following this webinar. Number 3, we'll understand how to position and help your clients prioritize their protection needs and objectives as part of your fact-finding discussions. And number 4, have some ideas how we can ask the right questions to position protection features and benefits to help you build a tailored solution. So in that, we're going to take the conversation away from price, but actually what is it that the client is actually interested in. And finally, as I alluded to, we're going to understand how to design a sophisticated but affordable protection portfolio which serves to address multiple client protection needs and objectives. So let's get started and take a look at the state of the protection nation. Now, Royal London published its 3rd State of the Protection Nation report last year in June 2019, and in that report it's quite interesting because we actually spoke to quite a lot of people. As you can see on the slide, we spoke to over 2,000 members of the general public, and that is UK adults age 18 and above. And we also spoke to 200 financial advisors. Now, if you want to have a look at that report in more detail, there is a link on the slide, but if you go to Google and type Royal London State of the Protection Nation, it will pretty much be the first link that appears. Let's take a look at what some of the people that we spoke to told us. In the report, we actually segmented the general public into different demographics because it was quite interesting when you group people up to see whether there are certain trends. So taking a look at the first demographic, this is what we would call single earners. Now, typically these people are 30 to 49 years of age. They may well not be your typical client, but you can see on the slide there, in terms of the makeup, we have people who live in purpose-built flats or home sharers, limited pension and retirement provisions, perhaps below average wages, working full time. 9% of that group that we spoke to agreed that people in employment, so in other words, people who work, should consider, not necessarily have, income protection. Only 9%. So does that mean that on the flip side, that 91% of people that we spoke to didn't even agree with that? They didn't even agree that people should consider income protection. I don't know what your opinion is about income protection as a protection solution. Now, 80% of that group had never had any type of critical illness cover, and they stated that it was either too expensive or that they didn't need it. Now, you'll see a bit of a trend here that when we speak to people about their need for insurance, the vast majority of people just don't see bad things ever happening to them. Now, 18% of that group told us that the cover that they've already got meets their needs. I guess it begs the question, what type of cover do they actually have in place? And 52% of that group told us they would last less than 3 months on their savings or investments if they couldn't work due to illness or injury. So half of them did admit that they would be in trouble if that happened to them. But you can see the contradiction there, that most people just don't see the need for even considering a solution like that. Now, the next group that we spoke to were what you might call millennials or Generation Z. And you can see here that typically these people are young singles, they're home sharers, private renters, grown up with technology, using personal banking apps perhaps. Social media is a big part of their lives. And you can see that 68% of that group had never had or currently don't have a mortgage. So it may well be that there's a big opportunity to start the protection conversation with these people once they do pursue getting on the housing ladder. 17% of that group told us they were likely to buy income protection in the next 5 years. I guess the question would be, that we don't know the answer to, how many of them will buy income protection over the next 5 years? 19% of that group told us they were likely to buy critical illness, so just a little bit more appetite for critical illness as a solution. And 56% of that group told us they would last less than 3 months on their savings and investments if they couldn't work due to illness or injury. So again, half of that group told us it would be a big problem if they found themselves in a position where they were what you might call long-term sick. Now, the final group is what we call the money makers. Now, these may well be more in line with your typical clients. We're talking about 35 to 50-year-olds, and the makeup of these people is usually successful, living in large homes, detached properties, mortgages still outstanding, mature families, possibly adult children, high disposable income, and again, tech savvy, using social media. 58% of that group told us that they've got life insurance or they've had it in the past. So does that suggest that they get the idea of protection a bit more? Possibly, more than 1 in 2. 52% of that group stated that life insurance is essential for anyone with a mortgage or with dependents. And 20% of that group told us that they agreed that everyone in employment, so everyone who works, should consider income protection. Now, if you compare that to the first stat that I showed you, which was 9% of that other group, now that's 100% more. 100% more. It's still quite low. 20% is still quite low, but it's at least 100% more than what the first group told us. Now, 22% of this group have currently got critical illness cover, which is pound for pound, arguably the most expensive protection contract you can have. Now, some other interesting findings that we found in the report was that if you look at the entire group of people that we spoke to, 15% of consumers believe that everyone in employment should consider income protection. So do you agree that that figure is still a bit too low? That only 15% of people that we spoke to in a 2,000-person survey believe that people should consider income protection when they work. 27% of consumers that we spoke to are confident that the cover that they already have in place meets their needs. And finally, if you look at our report, looking at the entire population of people that we spoke to, only 11% of people felt they were likely to go on sick leave for 3 months. So in other words, they couldn't see it happening to them. Only 14% of them thought they were likely to have an accident that meant they were unable to work. Now, if you look at the popularity of protection products, now this is from any sector across the whole of the UK financial services industry. This graph on the screen here shows the number by volume of protection sales. And we've got there term, critical illness, income protection, and whole of life. 1.5 million policies were sold for term life assurance. 500,000 policies, just over, were critical illness, and income protection was actually one of the best years we've ever seen. 148,000 policies were sold. Now, this data is from 2018 because it's published the year after in 2019. So it is the most up-to-date data that we've got. So do you agree that income protection should be less than 10% of term sales? And if you look at whole of life, that comes in around 300,000 policies sold. So what does all of this mean? Well, certainly if we break it down a bit further, if you look at term assurance by way of the type of term assurance, you wouldn't be surprised to see that probably most sales are level term assurances and decreasing term assurances. So probably a lot of mortgage related activity there. Relevant Life, which is a relatively new protection product to the market, is 27,000 policies. And of course, if 1.5 million term assurance policies are being purchased each year, I would guess that one of the reasons which makes that product so attractive is because it is cost effective. But if you ask yourself what the most cost effective term assurance policy is, it is actually family income benefit. And would you be surprised to see that it's only 24,539? That's the volume of all sales across UK in 2018. If you look at life term assurance policies with critical illness, you can see that 263,000 were level term assurances, 212 were decreasing, so almost certainly very much related to mortgage cover, and just a fraction there were income related critical illness policies. Now, we've seen a lot of innovation in the protection market, and certainly no more than income protection. And one of the biggest innovations that life insurance companies have done, they've been able to distribute high quality income protection, but with a cap. The cap is how long that the life company will pay the claim for. And by capping the length of time that the life company pay the claim, that can actually massively bring the cost down. Now, you won't be surprised to see that full income protection, so where a claim comes in, the life company is obliged to pay the claim until the claimant returns to work or the plan finishes. More recently, we've seen the advent of 1 year versions of income protection, so the claim will be paid for up to a year, up to 2 years, and even more recently, up to 5 years. So these innovations are pushing income protection sales in the right trajectory, which is upwards. Now, if you look at the final graph from my Swiss Re data, this actually shows income protection sales across all channels, and it's interesting to note here that directly authorised, so directly authorised means you're directly authorised to the regulator or you're with a network that is, and you might be acting as an appointed representative. Tied, 23,000 income protection sales were through the Tied channel, and Tied means where the life company has its own Tied sales force. Bank assurance is through a bank, and the final one is direct. What do you think direct means? Direct means the internet, and it means direct mail. So most of those, I would imagine, are not coming with financial advice sitting behind them. So when you look at those millennials that said they were likely to buy income protection over the next 5 years, it's unlikely they'll be able to do it without financial advice. So let's take a look at profiling attitude to protection risks. Now, of course, as we broadcast this towards the end of the 2019-2020 tax year, certainly many of you will be having conversations with your clients about investing in an ISA, perhaps, before the end of the tax year to utilise the allowance. Now, as an advisor that gives advice, you know that you have to deal with rules and regulations. And certainly in terms of profiling attitude to investment risk, you know that you need to have a conversation about the client's attitude to risk. And attitude to risk simply means to understand how much risk your client is prepared to take with their money and their assets in a particular time frame. Now, that conversation that you're going to have is subjective because it's based on feelings, it's based on beliefs, and you'll usually use some kind of profiling tool to help score the client. But you don't just leave it there, you'll also be having a conversation about their capacity for loss. Now, that means the amount of loss that your client can actually afford to bear. And that conversation is objective, it's practical, because it's based on the client's ability to absorb falls in the value of their investments. Now, the Financial Advice Market Review paper had an interesting comment in there that I'd like to share with you. And it says that in terms of profiling attitude to investment risk and giving investment advice, it says if any loss of capital would have a materially detrimental effect on your client's standard of living, you need to take that into account in assessing the risk that your client is actually able to take. So I'm wondering, what would it look like if such a thing existed for protection? What would an attitude to protection risk profile look like for a client who had no or minimal financial protection cover in place? Now, the scale that you can see on the screen is actually taken from the Royal London Attitude to Risk profile tool that we use for pensions. So would a client that had no or minimal protection look something like that? Now, would that profile be typical of your average investment client? In fact, how would a client with no or minimal financial protection, how would it affect a family if that family suffered the loss of an income forever? So let's take a look at a couple of case studies. Now, we've got here John. John is 35 and he's a self-employed plumber and he's divorced. He pays maintenance to his ex-partner and he's got 2 children. lives currently in private rented accommodation, and he earns a decent salary at £50,000 per annum, and he doesn't have any protection cover in place. Let's just imagine that we had a frank conversation with this man about the impact of sickness, incapacity, and death. What would be the things that he would tell you he's most concerned about? Well, it may well be, can he pay his rent each month? What about the upkeep of those maintenance payments? Maybe they're quite important to him. What about if he lost an income, could he get a replacement income? And what about access to lump sum funds, perhaps in the event of a critical illness? If we look at Jenny, our millennial, she's young, she's at the start of her career path, unmarried at the moment but has a partner, doesn't have children at the moment, and she's just bought her first home. She doesn't have any protection cover in place, so what would she tell you the things that she would be most concerned about? Well, it's going to be much the same. Can she pay her mortgage each month? What about, can she pay her mortgage off should something terrible happen? What about access to a replacement income if she lost her own income? And what about access to lump sum funds, perhaps in the event of critical illness? So if we take a look at Derek, our third case study, Derek's 44 and he's employed in senior management. He's married with 3 children, his spouse doesn't work, and they do enjoy their lifestyle. They like to have expensive holidays each year, and they've got a large fixed rate mortgage, and again, no protection cover in place. If we were to sit this chap down and talk to him about what he would be concerned about in terms of protection risk, I think it's going to be much the same. Can he pay his mortgage each month? Can he pay his mortgage off? What about access to a replacement income if he lost his income? And what about access to lump sum funds? So let's take a look at the chance, risk and probability of a typical client. So in this example, it's a male, smoker, age 35, next birthday. He's probably going to work until age 70, and he doesn't have any protection plans in place. And I want you to imagine now that you had 100 clients like this on your client base. Let's take a look at the risk and the chance that one of your clients would actually need to make a claim on a protection plan during their working lifetime. Now that is 100 people. And first of all, let's take a look at the chance of one of your clients dying before the age of 70. What would you imagine the chances to be? There's a 12% probability. So that means 12 of your clients will die before the age of 70. What about critical illness? What about people who actually suffer a serious illness that gives rise to a critical illness claim? How many of that same group of clients could we expect will make a claim before the age of 70? Well, you can see the number is higher. It's a 34% probability. That means that if you had 100 clients like that, we'd expect 34 of them to actually suffer a critical illness and they'd be able to make a claim if they had a policy. And what about the income protection scenario? What about going off work sick? The test here is 2 months or longer. How many would you expect? Do you think it'd be more or less than the critical illness? Well, based on the data that we have, it's a 46% probability. That means if you had 100 clients like that, we'd expect nearly half of them would go off work sick at some point during their working lifetime for longer than 2 months. And of course, the biggest chance of a protection claim whatsoever is actually the chance of any claim. So if we look at the same group of people again, the chance of any claim before age 70 would actually be, as you can see, quite a lot. And in fact, 69% of your clients would register a claim. That's 2/3 of your client base. Now, not all straight away, not all immediately, but at some point during their working lifetime. Now, of course, you might be wondering, well, if my clients saw that data, would that help them to understand their priorities? Would it motivate them to take some kind of action? Certainly what you can see here is the risk pyramid that's taken from our risk reports that you can produce through the Royal London portal. I think it's important to show clients the chance, the risk, the probability of actually making a claim, because you never know, if the numbers are significant enough, it may well help them to understand the need for protection. Okay, so let's take a look now at protection objectives. Now, in this industry, we talk a lot of jargon. Now, very often we have to explain and translate certain terminology to our clients. Now, when we're talking about protection, we're talking about financial protection. But what is financial protection? How would we explain it to a client? It's something that allows us to maintain a lifestyle or pay off debts. And that's in the event of sickness or death. So let's take a look at attitude to risks for protection and capacity for loss. And we'll use Jenny, our millennial. She's 28, she's employed, and she's told us that she's got a budget of £60 to £80 per month to spend on protection. So what do you think a typical protection recommendation might look like for Jenny? Now, if you look at the bullet points, there's a couple of clues in there. Certainly, she doesn't have any protection in place at the moment. So what would be a good starting point? Well, she's purchased her first home, so maybe mortgage protection. And it's very likely that with a budget of £60 to £80 a month, it may well be mortgage protection that includes critical illness cover. If the budget was smaller, it may well just be life insurance, mortgage protection. Now, there's nothing wrong with that. If you look at this table in terms of what we're able to achieve for that client, certainly if she bought life insurance and critical illness cover that was designed to pay off the mortgage, then of course we can put ticks in those boxes to repay debts, but certainly nothing against lifestyle at all. And that's really what protection portfolios is all about. It's about understanding that there are various protection risks that people face. Some are greater than others. It's also about understanding what the client's priorities are. Should the worst happen, what is it they want to achieve? So before we build our protection portfolio, let's take a look at some reasons for recommendation. And what we're going to do here is we're going to ask some questions. We're going to translate some features and benefits that are going to help us understand whether that's important to the client, and it'll help us tailor the solution. Now, all of these here are Royal London specific, but they will take the conversation away from price and actually about value and advice. So the first one, it's usually possible to include additional cover at a small or no additional cost. In the event that you suffer a broken bone or a fracture, it would pay you a small lump sum, say for example up to £4,000. How important would it be that I factored that into my research for you? Now, what have I actually described? What I've described there is a benefit and feature called fracture cover. And certainly that's a protection feature that pretty much speaks for itself, but some of them are a bit more ambiguous, and sometimes you do need to explain and translate the feature so the client understands how it could benefit them. Let's take a look at another one. It's possible for me to include access to added value support services to any solution that I recommend to you. Now, that could include free second medical opinions in the UK, access to dedicated nurses, rehabilitation support and more. Is it important that I factor that kind of thing into my research for you? Now, what have I just described? Well, I've just described something called Helping Hand, and that's actually automatically built into every Royal London plan at no extra cost. Let's take a look at another one. Now, any recommendation that I put forward to you will provide cover for you and your family for a long time. So is it important that the amount of money that you and your family would receive keeps track with inflation? And again, what have I just described? I've just described indexation, very typical of the protection market. And of course, it allows the client to make an informed decision about whether that's important for them or not. How important is it that any solution I design factors in additional cover for pregnancy complications and additional tailored cover for your children beyond the main adult cover? So certainly with a client who might be expecting their first child or have children already, that may well be something that resonates with them. Now, what I've actually described there is enhanced critical illness cover with Royal London. Now, that actually offers extra cover for a range of specific child-related conditions, and it also offers pregnancy complications, and that might resonate very well with your client and therefore help you to design the solution. How important is it that we keep the number of applications that we'll need to complete and the number of direct debits that leave your bank account each month down to a minimum? And that might be quite important to ask the question if we're thinking about designing protection portfolios. Do we want to actually spread applications to different providers, or would you like to keep them all centrally? Now, I've just described menu cover there with Royal London, and I'll show you what that looks like in just a second. Now, the final one I'll look at is how important is it that any solution that I design for you includes the flexibility to adapt to your changing circumstances in the future. So, as an example, that you can adjust or change your cover as your circumstances change. Again, it's just having that understanding of the market to see what different life insurance companies offer. What I've just described there with Royal London is the flexibility of the menu, guaranteed insurability options, and it's also the ability to have a lifestyle review. And that might be where your client's given up smoking, for example, which means that we'll look at it again and we'll look to reverse the smoker terms to non-smoking terms, and as a consequence we'll reduce the premium. So let's take a look at designing a protection portfolio. Now, in this example today, we're going to look at Jenny, as we've introduced already, and you know a little bit about Jenny, and also she's just gotten married to John. Now, John happens to be the self-employed plumber that I introduced you to earlier. Now, they don't have any children between them, but they are expecting their first child. They've purchased their first home together, and they don't have any protection cover in place. Both of these are non-smokers. Now, they want to see the protection risk analysis up to age 70. They do have a small amount of savings, and they would like to look at their retirement plans. So we've actually set up a separate meeting to talk about retirement planning beyond this meeting today. Now, as I alluded to before, the protection budget is around £60 to £80 a month. Now, I'd say that's a pretty decent budget, but nevertheless, we're probably not going to be able to do everything for them. So the first thing I need to do as part of this conversation is set up the risk analysis, and we're going to get the risk profiles for Jenny and for John. And as you can see there, the risks are significant. For Jenny, we're talking about a 65% overall chance of claiming on a protection policy, and for John it's a 1 in 2, it's 50%. So I'm going to proceed to have the fact-finding conversation with them and have a discussion about protection risks. So what are their client priorities? Well, what they've told me is they would like a replacement income if they're off work sick. They'd like to be able to pay off the mortgage that we've just set up for them, and they like the idea of some kind of critical illness cover. They've not looked at it before, they don't know how much it costs, but they like the idea of critical illness cover. And they do understand that they're exposed to protection risks across all 3 areas. So I'm going to go back to the office and have a think about what to do. What I'm thinking of putting together for them is a protection portfolio that looks a bit like this. I want to, if it's possible, if it's affordable, I want to offer them some mortgage protection because I know that that's not going to cost a lot of money. I want to put some income protection in place because that was the first priority for them. And certainly for John, he's a self-employed plumber. Now, I am scratching my head a little bit because I'm thinking that might be an issue. A plumber represents a higher risk occupation category, which could mean that the income protection for John could be quite expensive. So I'm going to see what I can do for him. Also, income protection for Jenny, I think, is a priority. And they like the idea of critical illness cover. But I also know that if I quote for life or early critical illness cover, it won't cost a lot more, and that means they get the life insurance as well. So that's where I'm coming from, and you might not necessarily agree with that course of action, and that's okay because advice is a subjective thing. But I'm thinking of, first of all, mortgage protection. So I've done a quote there for £150,000 of life cover, decreasing because it's a capital and interest mortgage, and the mortgage is 25 years, so I'm going to match up the term to that. And the premium comes in at £9.03 per month. So that's good news. That covers both of them. It's joint life cover, and it gives me a good £70 or so to play with. Now the headache area. We're going to look at income protection for John and for Jenny. Now, if we look at a maximum amount of income protection, let's start at the very top. Let's see what John and Jenny could possibly have by way of income protection. What we can see there, that if they came to Royal London for their income protection, we could offer them 35 years term, so for John up to age 70, 42 for Jenny, £29,000 based on John's £50,000 salary, and we've got index linked, so this is inflation proof income protection, 4 weeks deferred period, which is the shortest waiting period that we've got, and then full term. So that means potentially we could pay John for 35 years if he made a claim. Now, what do you think the premiums would be? I quoted these very recently in February 2020. The premium for John comes in at a whopping £199.48. Now, I think Royal London are pretty much in the middle of all the prices there. I don't think we're way off the mark. But of course, what we see there is that there's a lot of income protection for a very long time. It's a higher risk and there's a short waiting period. So the liability for the life company is quite significant. So even for Jenny, our millennial, £56.02 is the premium for her income protection. So of course, if I recommended those income protection solutions to John and Jenny, reality is there's no way they can afford them. They've given us a budget of £60 to £80 a month. There's no way they can afford £256 just on income protection. So we don't have a Rolls-Royce budget, so let's see what we could possibly do to bring the cost down a little bit. And I think this is where we've seen some of that innovation in the income protection market. Well, I'm going to be talking to them about retirement planning and their options there, and they don't want to work to age 70, so bringing the term down by 5 years will significantly help us with the cost. What is the main priority in terms of the income that would be received each month? Well, after having the conversation with Jenny and John, the most important thing is for them to pay their bills, to pay all the most essential bills each month. So what I'm going to put in place there is £1,000 a month of tax-free income, and that's for Jenny and for John. Obviously, at some point in the future, we'll look to review that and look to bring the sum assured up. In terms of indexation, I'm going to keep the indexation, but I am going to alter the deferred period. So instead of waiting a month, they're now going to have to wait 3 months for any income protection claim to be paid. So I'm going to pay attention to the savings that they told me that they had, and a recommendation will go in my suitability report to advise that they do maintain an adequate emergency fund. Now, maybe some of you think that's a bridge too far for this particular client, but of course he doesn't have £199 to spend on his income protection. So the final thing I'm going to do is look at the payment term. Now at Royal London, we can offer a 5-year payment period, and that will significantly help with the cost. So that's 60 pay days. It's 5 years of income protection claim should he go off work sick. So how much do you think that would have brought the costs down for both of those plans? So we're looking at the moment, about £256 a month, and that's brought the cost down to astonishing £43 a month or so. So I suppose that goes down to your philosophy of, if you can't have perfect, is it okay to compromise? And of course, as I said, advice is a very subjective thing. It's about your beliefs as an advisor. It's about what you think is the right thing to do. And it's about the conversation that you've had with the client. So on my protection portfolio, what I'm going to do, I'm going to recommend those income protection plans that we've just looked at on the screen. So we've got £29.34 for John, and we've got £13.24 for Jenny. Now, if you look at the Life Earlier Kick, we've actually got there a £25,000 lump sum for John, and we've got £25,000 lump sum for Jenny. Now, both of those include enhanced children's critical illness cover, so that covers those pregnancy complications because they are expecting, and it also covers conditions specific to children. So I've been able to put those in and still fit all of that within the budget. So I actually had about £7 or so to play with. But the question now has to be, could we have done any better than that? Now, for those of you who are really familiar with Royal London, what you'll know is that we're particularly good at combining solutions together, and we call it a protection menu. What a protection menu simply means is we're going to do exactly the same cover again, but this time we're going to put them all on one application form. It'll be one set of underwriting, and it'll be one direct debit that leaves the bank each month. When I quoted those illustrations in February, each of those quotes did actually include the Royal London standard plan fee. Now, the plan fee at Royal London is £2.60. Now, of course, if you do a menu plan, which means you do it all in one quotation and one application form, then you only ever pay one plan fee. So we're going to design that same protection portfolio with Royal London, which means the same 5 covers that we talked about, and we're going to put them onto a menu plan. Automatically get waiver of premium because they've chosen income protection, and the total cost now for exactly the same cover is coming in at about £65.83. So that means that actually I've got the best part of £14 to play with. Now, you might be thinking that the one area that you were a bit uncomfortable with about that recommendation is the income protection for John. He couldn't afford the maximum cover, so what we did have to do is compromise. But now I've got £14 a month to play with. I've got a question to answer, which is, do I alter the sum assured? Do I increase his £1,000 a month of income protection, or do I look to reduce the deferred period? I think what I would do is I would look to reduce the deferred period, and that's what I've done there. I've actually brought it down from 13 weeks to 8 weeks, which brings that total menu plan of protection covers down to £77.67 per month. Now, when we looked at Jenny before, a mortgage client, first time buyer perhaps, with a decent budget, that is going to have a conversation about protection, I think we all thought typically she might end up with a mortgage protection life and kick. I guess the question for you guys is, do you think that that looks more elegant and a more sophisticated solution? So let us know what you think about the webinar. Advice is subjective. It's about what you think is the right thing to do. But I think with technology, we do have the ability now to create more sophisticated and elegant solutions for our clients. Certainly the one that we looked at today was one quotation. It was one application form. So one plan fee, which brought the cost down significantly, and also one direct debit leaving the bank account of the client each month. So thanks for tuning in today to the webinar. These are the learning outcomes. So that's what we should have covered by the end of this. I'd like to say thank you very much for tuning in. I hope you found it useful, and good luck for 2020 with protection, and I'll see you around at some point in the future. Thanks very much. Bye-bye.